Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. Today we are going to revise about valuation of intangibles, and there are 6 methods to value intangibles. The very first one is relief from royalty method. The second one is multi-period excess earnings method. Third one is with and without method. Fourth one to measure intangible assets is option pricing method. And the last two are replacement cost with obsolescence method and obsolescence factor in replacement method. Let's understand the very first one, that is relief from royalty method. Here you will value intangible assets like brand, intellectual property and software to whom you make royalty payments. Here, even though you have these intangible assets with you, but you will assume that your business doesn't own these intangible assets, and if your business doesn't own these intangible assets, then how much payment you would have made to the third party in the form of royalty to licensing these intangible assets. So here your value of your intangible assets will be determined by present value of avoided royalty payments. That means the payment which you are making to the third party for licensing these intangible assets. Here the royalty payment will be decided based upon percentage of sales, because in most of these licensing agreement for these intangible assets, your royalty payment gets decided based upon percentage of sales. So here also we will take royalty payment which is percentage of sales. In question they will give you revenue projections. This will help you to estimate the revenue for projection years, and it will also give you the base for royalty calculation. Also in the question they will give you a royalty rate. This rate will be adjusted based upon companies and asset specific risk and return. You have to apply this rate to the revenue. You will get the royalty payment before tax. You have to make it after tax, and then you have to discount it. Let's understand this method with the help of an illustration. So in question they will give you the projections of revenue for certain period. They will also give you a royalty rate. You have to apply this rate on these projections and have to calculate royalty payment before tax. Then you will do this tax adjustment and will make your royalty payment after tax. The reason you do this income tax adjustments, because of this royalty payment you will be having tax savings. Let me explain you with the help of this example. So here there are two scenarios. In one scenario you are not making any royalty payment, and in second scenario you are making royalty payment. So here your profit before royalty was 1000 and you paid tax on these 1000 rupees, which came up to be 200 rupees. That is 20% on 1000. But if you're making a royalty payment, then this royalty payment is tax deductible, which will reduce your tax, and your net taxable income will become 800 rupees and you will pay tax on 800 rupees. So 20% on 800 gets 160. So here you can see, because of this royalty payment which is tax deductible, there has been a tax savings of 40 rupees, which is nothing but 20% of 200. That is your royalty payment. So if you're assuming that you are making payment to the third party for this license, for licensing this intangible assets, then you also have to consider the benefit which you will have after making this payment. So you have to make this royalty payment after tax, after considering the tax savings which you will have. So this is the projected after tax royalty for the projected year. So here you can see the calculation is same like you did in DCF, where you projected the free cash flow for the firm, discounted that cash flow, and then you calculate the present value of these cash flows. There you also add the terminal value, because your business is not going to get shut in 2028. Definitely it will run ahead. So here also your brand will not get vanished in 2028. It will also be there in upcoming years, but you can't project for each and every year. So you calculate one value which will represent your royalty payment after tax from 2029 till infinity, and that is nothing but your terminal value. So here once you have these after tax payments, you will discount it and will calculate the present value. Then you will do the sum of all these present value, and then you will add terminal value. The formula for terminal value is the same which we learned in chapter number 3, that is Gordon's growth model. The, the formula is your after tax royalty payment for the last year, that is 508 1 plus G divided by cost. Here in that you will take cost of equity, here you will take discounting rate minus G. So I will correct it. There you will take cost of equity, but here you will take the discounting rate minus growth, which is 508 into 1.04, which is your growth rate. And then you will divide it with 10%, which is your discounting factor, minus 4%. You will get 8,805. You will discount it with this value and you will get the terminal value, that is 5993. You will add this terminal value and you will get the fair value of your intangible assets. So here there are also some factors which will increase your royalty percentage, and there are also some factors which will decrease your royalty percentage. Let's understand this. If you are valuing one asset, intangible assets, which is a bundled asset, which also has trademark and also has some formula, and definitely this asset will have higher royalty rate compared to the asset which is a standalone and only has one asset in it. Then if your asset has broad use, means it is valuable across many countries, it is also has a long-term use, and it is also has a free use. So definitely that means unrestricted use. That means definitely for such asset your royalty rate will be high compared to those assets which has limited geographical use. Also the rights to use such asset is for short-term purpose. Royalty rate for such assets will be low. Then if your intangible assets is giving high profit potential for the company, then the royalty rate for such asset will be high compared to the assets which has low profitability. Then there is about upfront fees or cost sharing. So if I have one brand and some third party came to me that they want to use my brand, but they will not give me any upfront fees or cost sharing. So if I am charging them royalty to use my brand, then definitely at that time I will increase my royalty, because they are not giving me any upfront fees, or not they are also not even sharing cost with me for the advertisement of their brand, because now this brand will be helpful for me also and for them also. But if there is one client which is telling me that, sir, I will give you this upfront payment and I want to use your brand, also if want we can share the cost for advertisement of this brand, because if there is a awareness of this brand, it will be beneficial for you, also it will be beneficial for me. If he is giving me upfront payment or he is sharing cost with me for this brand awareness, then definitely I will charge him less royalty rate compared to the person who is not giving me any upfront fee or not sharing any cost with me. So these are some factors which you have to check at a time of deciding this royalty rate. This is your first method to calculate intangible assets. Now let's understand second method, that is MEEM method. This is multi-period excess earning method. This is used to value intangible assets which are most significant, but the direct measurement of such intangible assets is not possible. That means you use this method to value customer relationship. Now you can't directly measure customer relationship, that 20% of your revenue is because of customer relationship. So here you value such intangible assets through this method. In this method you will using residual approach, where you will first understand the economic return company is able to generate through all assets. That means the cash flow or earnings the company is able to generate through all assets, and then you will reduce some of the portion of this calculation, that is cash flow or earnings, that is the generated from other assets. So here the remaining portion, that will be the excess return, will be attributable to the specific asset. Means first you will take the earnings from all asset, you will reduce some returns which you are able to generate from other asset, then the remaining one will be the excess return which will be attributable to the special asset which you are valuing. So here to value your asset through MEEM method, there are two ways. The one is multi-period and the second one is single period. Here in multi-period you will make the projections for a few years and then you will calculate the terminal value. Adding it, you will get the value of the intangible assets. This is the multi-period approach. But in single period, what you will do is you will find out the excess return your company is able to generate, and you will consider that excess return company will generate for the rest of their life. Then what will be the present value of intangible assets? This is the two ways to calculate value of your intangible assets through MEEM method. But here what ICAI has done is they have given key steps for multiple period, but the illustration is of single period. But there is nothing to worry about, because in 5 steps, the 4 steps are similar, just this 4th step gets different. Let's understand it. In multi-period, like I said, you will make the projections. So you will estimate the future after-tax cash flows or earnings you are able to generate through all assets. You will assess the validity of your projections and assumptions, and then you will deduct contributory asset charges. These are the returns which you are able to generate from other assets. You will deduct CAC to isolate the asset contribution, and then you will get the excess return. You will discount this excess return to calculate the present value. You will add a terminal value, and you will get the value of intangible assets. But here you also have to add tax amortization benefit, because it says that if you're booking an intangible assets in your balance sheet, so you will also be booking the amortization of it. In physical asset, like we book depreciation, in intangible assets we book amortization, and amortization is tax deductible, so your taxable income will be reduced by such amortization. So you are having tax savings from this amortization. So you have to calculate the present value of the tax savings which you will have for forecasted period, and then you have to add that value in your value of intangible assets. This is a tax amortization benefit. Once you add this in value, you will get the final value of your intangible asset. Let's understand the method to calculate your intangible assets in single period way. So here XYZ wants to value customer relationship, where the company's net operating assets are 180 crores and the net average earnings is 25 crores. Here the required return from net assets is 11% and the capitalization rate for excess earnings is 16%. So first you will understand what is the return you are able to generate through assets. So required return on assets, which is 180 crores into 11%. You will get 19.8 crores, which is the return which you are able to generate through other assets. Now you will consider your earnings and you will reduce this return, by which you will get the excess earnings which is attributable to your intangible assets. So your excess earnings will be 25 crores minus 19.8 crores, that is 5.2 crores, and then you will treat that this excess earnings your company is able to generate for each and every year till infinity. Then what will be its present value? So here you can see you have to use terminal value formula, which we have just explained it to you here. So here instead of 502, you will consider 5.2 into 1 plus growth upon discounting rate minus growth. But in question they have not provided growth to us, so we will not consider growth. We will consider 5.2 divided by 16%, which will give you 32.5, and this is the value of your customer relationship through single period way. So these are the two ways to calculate the value of your intangible assets. Then the third method is with and without method. Here also you will take present value, but here you will take net present value of expected cash flows in two scenarios. The first one is with the asset and second one is without the asset. In first, you will consider the cash flow business will generate with all the assets, including the intangible assets which needs to be valued. And second scenario, you will consider the cash flow business will generate without the specific intangible asset that needs to be valued. So the difference in these cash flows will definitely be the contribution of the intangible assets which we are valuing. So the steps to calculate this intangible assets value is: first, we'll make the projection for future cash flows in these two scenarios. Then we will analyze whether our assumptions and projections are good. Then we will discount this difference of cash flows and we'll get the present value, which is nothing but the value of our intangible asset. And if there is any tax amortization benefit, then we will add this in the value of intangible assets. Here we use this method for non-compete agreements. Let's understand this with the help of an example. Here there is one company, ABC Limited, who wants to determine the fair value of non-compete agreement with the help of this method. They have given us the cash flow in these two scenarios and have told us that 14.5 is the discounting rate and there is 40% probability of competition. So here, assume that ABC company has 10 founders with him. So the cash flows with non-compete represents that if these 10 founders has signed a non-compete agreement, so they will not accept client individually, and all the clients will be redirected to the company, by which company will be able to generate this amount of cash flow. If there is not non-compete agreement has not been signed between these founders, then they will start accepting clients on individual basis. And if all founders who are starting accepting the clients on individual basis, then what will be the cash flow company will generate? This is the cash flow without non-compete. And the difference of these cash flows will be the cash flows the company is able to generate because of non-compete agreement. So here we will take, you will discount all these cash flows and will take present value of this difference of cash flows. Here you will ask, sir, we are not taking terminal value here. We are not taking terminal value here because non-compete agreement are signed for certain periods. They are not for infinity. Hence we are not taking terminal value. We will calculate, we will sum all the present values for the projected years. And here we will multiply it with the probability of competing, because like I said, there are 10 founders. You don't think that each and every founder will go for in a competition if there is no non-compete agreement. I think there are only 4 founders who will go for the competition. So there are only 40% chances that they will go for the competition. So I will multiply this 40% from the sum of present values and I will get the fair value of non-compete agreement. So the probability of competing is applied at the end, because not all individuals who sign a non-compete agreement would have actually competed if there were no restrictions. And this probability of competing is not added in each and every with and without method. It is only be added when you are calculating the value of non-compete agreement. This is your third method, that is with and without method. Now let's understand our fourth method, that is option pricing method. Here you will value your intangible assets like a call option, because call option is a right and not an obligation which you will exercise only when the things are beneficial for you. That means if future outcomes are beneficial, profitable for you, then only you will opt for this option, or else you will directly ignore it. The same things happen with intangibles which are dealing with higher uncertainty. To give you an example, if there is a drug which is developed by pharmaceutical company, if this drug got clinical approval in their trials, then only it will be beneficial for a company and it will be able to generate 500 crores as a profit. But if this drug doesn't get any clinical approval, then it will not be able to generate any profits for the company and it will have zero value for a company. So here you can see the value of an intangible asset is dependent upon certain future outcomes. If these outcomes are beneficial for them, then only the intangible asset is valuable. So the same situation happens with call option. That's why these situations are compared, and you will use option pricing model like Black-Scholes model to value this future optionality. With this model, you will capture the value of this future optionality which we just understand, where you will see the value of this asset, if this asset is viable and how it is benefiting your company. Here we are not valuing our intangible asset based upon the general condition that it will get clinical approval. We are valuing it based upon an option that if this condition goes into company's favor, then what will be the value of this intangible assets. This can be understood by option pricing model with the help of Black-Scholes model. So in this method, you value intangible asset like a call option, meaning it captures the flexibility to take advantages of future opportunities. Here we use it in the case when there is high uncertainty, like in tech startups or pharmaceutical company. And we use option pricing model like Black-Scholes model to find the present value of our intangible assets. So definitely in exam they will not ask any practical question on it, but they can ask a question that which method you will use if there is high uncertainty in intangible asset. Which method helps you to value an intangible asset based upon call option? They will definitely ask such questions in exams, so be prepared for it. Now let's understand the last two methods to value intangible assets. Here the fifth one is replacement cost with obsolescence method, and the last one is obsolescence factor in replacement cost method. So here you can see that they have interchanged the names. So the final value which you get from both of these methods will be the same, but the way of presenting and the way of calculating the information is different. Let's understand first the replacement cost with obsolescence method. This method is used for your regulatory purpose and also in your valuation report. Here, we will first understand the cost of replacement. That is, you will estimate the cost of creating or acquiring a substitute asset which has equivalent functionality, which is nothing but your replacement cost. And then you will adjust it with obsolescence. That means technological advancements. That means if your asset has been outdated, then you will reduce the value. If your asset is not demanded in the market, then you will reduce the value. So here you will first take the replacement cost. And then you will reduce the obsolescence value. Here you will quantify the obsolescence value. Here you can also do the second way of also presenting is you can also write the functional obsolescence and then you can quantify. You can also write economic obsolescence and then quantify. And then the net value will be the fair value of your intangible assets. So here you will assess the cost of replicating the intangible assets, then you will reduce it for the obsolescence that can be technological advancements or due to market conditions, and the adjusted cost will represent the replacement cost with obsolescence. So here this method is used for valuing intangible assets which are technologically related and in which there are rapid advancements which impact the assets value. Now let's understand our last method, that is obsolescence factor in replacement cost method. So here also you will first take the cost to replicate your asset with modern equivalent, and then you will multiply it with obsolescence factor. There are two types of obsolescence. The very first one is functional obsolescence. So here you will consider whether your asset is outdated or your asset is less efficient compared to the modern alternatives. And second one is economic obsolescence. So here you will consider the external factors like changes in market conditions or technological advancements which will reduce your asset value, which will make your original asset less valuable. So the formula to calculate the obsolescence factor is 1 minus depreciated replacement cost minus current value of the asset upon replacement cost. So I will make you understand this formula in example, but let's first understand what is depreciated replacement cost. So here you will take this replacement cost which is there in denominator, but you will adjust it for physical depreciation. If you have used your asset for 2 years, then you will depreciate the replacement cost for 2 years. Simple as that. Then you will take the current market value of the asset. This is nothing but the fair market value of the asset which you have in current condition, considering all the functional or economic obsolescence. That means the asset which you have, what will be the current market value of that asset. And then there will be a replacement cost. This will be the new cost, which will be cost to acquire a new or cost to create this new asset, which is identical one as per current market prices. So here this formula will help us to calculate the proportion of value lost which is due to obsolescence. So here the example which I have taken is what is used in module, but this example is wrong because first they have said that the company has created a software of 50 lakh rupees and they have used this software for 2 years and the replacement cost is 25 lakh rupees. But at the time of calculating depreciated replacement cost, they have taken 50 lakh rupees, which is original cost. This is wrong. You have to take a replacement cost because here the name suggests depreciated replacement cost. You have to take replacement cost and then have to make depreciation adjustments. So this example is wrong, but I have taken it as it is. If this paper is new, so if ICAI asks the same question, then you should be ready for it. But I will give you one example. So if your company has created one software and the replacement cost of that software is 40 lakh rupees, the useful life of that software is 5 years and we have used it for 2 years. The market value of the software which I have right now is 18 lakhs rupees. So here I have to first calculate the depreciated replacement cost. Replacement cost is 40 lakhs and I will charge the depreciation for 2 years. That is 40 lakhs upon 5 into 2, which will be 16 lakhs, and my depreciated replacement cost will be 24 lakhs. Then I will calculate obsolescence factor, which is 1 minus DRC minus current market value upon replacement cost. So here you can see this 24 lakhs is after depreciation. And now I'm seeing that the current market value for my asset is 18 lakhs. Means the cost to create the asset which I have right now is 24 lakhs. But the people in market are only giving me 18 lakh rupees. So 6 lakh rupees they are not paying me because maybe my asset has been outdated, or it is doesn't have the market features which my asset requires. Means it is not technologically updated. That's why people are not paying me 6 lakh rupees. So when you divide this 6 lakh rupees with 40 lakhs, you will understand how much percentage of your new replacement cost has been outdated, has been obsolete. That is nothing but 15%. So 1 minus 15% will be 85%, and you will multiply this 85% with the fair value. You will multiply this 85% with the replacement cost, and you will get the fair value of software, which is 34 lakhs. You will take the 40 lakhs into 85% and you will get the 34 lakhs. This is how you calculate the fair value of your intangible assets with the obsolescence factor with the help of replacement cost method. So here the rationale behind taking an obsolescence factor is the very first one. You take replacement cost and adjust it, because if you have only taken the replacement cost, then it will be overestimate of the assets value. Then this reducing your value with the obsolescence, it will reflect the market reality, because obsolescence factor will incorporate the impact of functional and economic changes on the asset's current market value. Then this also helps you to make decisions, like the quantified obsolescence factor will allow you for making informed decisions regarding asset replacement and investment strategies. Now, with the help of this formula, with the obsolescence factor, you were able to understand how much amount has been obsolete. That was 6 lakh. So with the formula, you provided a quantitative measure, but it is also necessary to give the qualitative assessment of this obsolescence. That means you said that 15% has been obsolete, but now you have to bifurcate this 15% in functional obsolescence and economic obsolescence. Your functional obsolescence means it will evaluate the outdated functionality due to technological advancement, user needs, and economic obsolescence means you will assess the external factors like market shifts, regulatory changes which have affected your value. So in our example, 15% was a obsolescence fact, 15% was the obsolescence value. Now we will allocate it in functional and in economical. In functional, you can say that it was 10%, and in economical it was 5%. So this will be, allocation will be done based upon a professional judgment, but you have to allocate it to understand how much amount is due to functional obsolescence and how much amount is due to economic obsolescence. So by this, you will combine quantitative formulas with qualitative assessment, and this is the end of your 6th method. And this conclusion tells you that which method you have to use. So the choice of the method will depend on the nature of the intangible, availability of the data, and the context with which your valuation is getting conducted. So this is the end of your part 3. And in the next part, we are going to take WACC and VARA reconciliation, which is very, very, very important. And at the end, we will take valuation of liabilities, which is similar with your FR syllabus, but important for the exam. So that's the end of your part 3. Hope you are loving these lectures. Don't forget to subscribe and like this video. Tata, bye bye. See you in the next lecture.